Hello, everyone, and welcome to the latest episode of Meet the Investor. Today, we are fortunate to have Dan Barker joining us. Dan is the founder of Apis Capital Advisors, who, amongst a few other strategies, runs a long-short global equity strategy that's been going for over 20 years. Apis overall has over equivalent of Australian $1 billion under management and serves institutional and private clients across the world. Thank you very much for joining us today, Dan.
Happy to be here.
Um, Dan, I'd like to start off with asking our guests a little bit about themselves and the firm that they work for. So I'd appreciate a little bit of your history and firm's history if you could go into that, please.
Sure, happy to. And don't want to take you all the way back to my college dorm room where I kind of caught the bug for equity investing. But yeah, I've been a sort of passionate investor for 30 plus years. My first professional job out of college, this is going back to 89, 90. I worked for General Electric Corporation in a sort of finance role. They had these training programs. I had, as I caught the bug in college, to do equities and to do essentially what I do today. Was started to work on my CFA while doing corporate finance at GE. Thought after that training program was over, I would go on to somewhere else. But as luck would have it, I was able to stick at GE and work for the pension fund for General Electric. So my role there was as a European equity analyst. That pretty quickly evolved into managing money. This was, again, 30 years ago, in large cap European portfolios. I was interested in small cap. I was interested in emerging markets. And if you were interested and could do good work, GE would give you things to do. So I really had a fantastic, I even say that today, that, a lot of what you get with our firm today is sort of many, many years of, obviously thousands of relationships that we've built up over that time with companies, with buy side, sell side. And, for what we do, which is essentially small cap investing on a global basis, it is very much about networking and being able to get to the bottom of things, relatively quickly through that network. And so 10 years at GE, then went to a place called J&W Seligman. Again, this is a mutual fund management company. I ran products in, again, small cap, global, and emerging markets. That's where I met my partner, Eric Alvarez, we were 50-50 partners at Apis Capital. And then in 2004, we spun out to start Apis Capital. So Apis has been around for, as you said, 21 years now. And yeah, just in terms of the firm, I think just as a broad outline, we were in a way sort of frustrated. We had products in small cap global equities. We were active in emerging markets, and when you're an investor in those types of asset classes, obviously you have to stay in your lane. If you're an emerging market person, there's this subset of countries that you invest in, and that's fine. But we were bottom up, stock pickers, and we would go and meet companies and learn about their businesses, and obviously do the whole analysis of supply chains, customers, competitors, all that kind of stuff. And what oftentimes you learn is something in one place that might help you understand something else somewhere else. But because of your strategy, because you're exclusively small cap or you're exclusively emerging markets, if you were, as strange as it sounds, in India and you learned something in India that gave you an edge, as it were, in a U.S. company, well, there's nothing you could do with that. You have to invest in this particular set of countries. And for us, that was sort of a frustration. So the idea of Apis was to have a really borderless approach, to have the flexibility to go wherever the research takes you. If you can get the best leverage, the best combination of value and growth in Japan or Germany or Korea or the United States, it didn't matter. So for us, that just seemed like the ideal way to be a global investor and to sort of take advantage of that global perspective. And sort of maximize the advantage you get from that global perspective, to have this, like I said, this sort of truly borderless approach. And so the initial fund we launched in 2004, it is a relatively low net strategy. Typically we'll run, and I can talk about what those terms mean, I guess, gross and net and things. But we're typically running 40 to 60% net, which means our longs minus our shorts equals that. And it allows stock picking, which is what we say we're good at, to show through. And again, we'll feel the markets when they move, but it's a relatively low market exposure strategy, which is designed to kind of allow stock picking, if we're good at it, both on the long side and the short side, to show through.
So you were talking about long short as I introduced one of your flagship strategies and you've touched on there your oldest strategy. What does that mean specifically when you're saying we run a long and short book, and what would a strategy look like if you're doing that in totality?
Yeah, I mean, there are a lot of people, and when we started, we would come from a long only background, and there's a legitimate question: can you be good at short selling? And there certainly is behaviorally a lot of challenges. It is, even though you think it's the other side of the coin, it is different, and it's a big challenge, and there's a lot of lessons learned that we've had over our time at APIS. But we try to make money. There's different strategies. Some people pair trade. In other words, they have one idea, and they think if they have a long shot idea in Korea, they maybe want a short idea in Korea to kind of offset that and to get rid of the quote unquote Korea risk. We don't do that. I mean, we do want to give you broadly a global fund, and we're cognizant of those risks that we're going to take. But we want to make money on our longs, and we separately want to make money on our shorts. And we're trying to make an absolute return on both sides of the equation. So we don't really pair trade. We're here to, in our strategy, trying to make money on both sides, and it obviously has a risk reduction function as well. When markets are down, if we're doing our jobs correctly, again, if we're net long, we're still probably going to feel some of that, but we should sort of cushion some of that downside. When things go well, maybe we won't enjoy all the upside because our shorts, are probably participating in some of that market move up. But generally, as I said, our goal was to kind of not neutralize. You can't do that, especially in a small cap global strategy. It just would be technically very difficult to do. But over time, to kind of reduce some of that, mitigate some of that market risk, and allow the stock picking to show through. And that's our goal.
So you've referred there to short selling a few times. That's effectively meaning like you're selling the stock. You don't want it. You believe that company is going to decrease in value. You enlightened us a little bit about the process behind short selling, what that means practically.
Sure. I mean, there is sort of the technicals of how short selling works. I mean, at the very high level, you can believe a stock is undervalued and worth more and you want to buy it, or you can believe it's overvalued and worth less and you want to sell it. So short selling is a way to make money if there's downside in a security. The technicals of how it works, if you had for example, a $10 stock and you believe it's worth, something less, you'd go to your broker and say, can I borrow that stock? You borrow that stock from them if they have it, and you sell it immediately. And then, so on their equation, you've got $10 with the broker, but you also have a negative balance as you owe or you're short. That's that $10 stock. If the stock does as you hope, it goes down. Say it goes down to $8, you can say, okay, I'm done. I'll buy that stock back. In that case, you'd make the difference to the 10 minus the 8. Obviously, there's a whole set of risks. Stocks can theoretically go to infinity. Your losses can be infinite in theory, and you can only make 100% on the downside. But the truth is, if you're, as you can imagine, as a good idea on the short side, it actually gets smaller. And so from a portfolio risk management, that's a whole different mindset. You need to add, good short that's working, you generally want to add to it. You can make, more money, I guess, if the other thing, some people who really look for zeros, they want companies that are absolute frauds. If you never cover, you never pay taxes. It's sort of an interesting and odd feature. It just disappears, and you don't realize your gain. Probably Enron trades at 0.000001 cents in a pink sheet somewhere. So it's kind of a unique feature. We do a little bit of that. We look for frauds. We look for companies like that maybe are zeros, but generally speaking, we cover. You do have to pay taxes on the gains that you make in those situations.
And you were touching on one of the reasons you went to APIS or set up APIS was to get that global exposure. Are there particular markets you like or that you play in outside of the US?
Yeah, absolutely. And I think, it's important for you. I mean, maybe unfortunately, we've probably been leveraged to more markets outside the US. I mean, the US has been kind of the place to be for, seems like almost our whole duration in the last 2 decades. But for better or worse, we've still done okay, but we have a significant weighting in Asia. I mean, this is truly a global strategy. I think if you look at long term where we've positioned the funds, it's kind of been a barbell, but maybe 40-40 between Asia and North America, maybe 20 Europe. But it's about very much a bottom-up driven. Where do we find opportunities? Where do we find dynamism? Where do we find attractive valuations? It's tended to pull us, maybe towards North America and Asia. Certainly, if you look at global benchmarks, which we really don't. I mean, we want to give you a global fund, but we don't really care what the benchmarks are. We just want to make money, and so we are relatively overweight Asia, probably a little bit still even overweight Europe relative to those benchmarks, and probably pretty significantly underweight. But again, just kind of where do we find attractive companies that are reasonably valued? That's maybe pulled us a little bit of it. But the U.S. is a very dynamic market. There's always opportunities here as well. So it's a truly global fund. I think it is something that kind of differentiates what we do. I think a lot of, when we've looked at other people, they call themselves global, but maybe they're 20%, ex-US, and we've always been probably majority ex-US in our global strategies. So in terms of and as I mentioned, we look at things that require a global perspective. So when you think of the countries we're in, it isn't going to be frontier markets. It isn't going to be Africa. It isn't really going to be Latin America. There aren't very many global businesses in those regions of the world. Western Europe, North America, Asia. If it's emerging markets, Taiwan, Korea. I mean, these are very global. They're global companies competing, and where we can do our work as global investors. They're in the tech supply chains. They're in the industrial supply chains. And they're naturally global. If you go to Korea and you want to be big, you've got to get out of Korea. It's not that big of a country, and so they think global from the very beginning. Sweden, another, a lot of successful big multinational companies, but they were built 100 years ago. But they were thinking globally from the very beginning. So those are good for us. But those frontier markets don't really fit. And again, those sectors, if you think about property stocks in Tokyo or Hong Kong or something, that's not a good fit for what we do. We believe there are local investors in those markets. Those are local industries. They're going to have an advantage over us. So there are sectors like technology, like healthcare, like industrial businesses, which are some consumer businesses. We probably wouldn't do a local retailer, but if it's a global business, it's fair game for us. And so there are countries that lend themselves to what we do, and there's also sectors that fit for our strategy.
And so you touched on a lot there about the work that you do. How do you identify a good company? And if you could also, part of my thinking there is you mentioning these Asian countries and so on. How can you, based out of the US and your team, get across the opportunities so globally in so many countries? If you could feed that into your answer about process, and maybe if you've got an example, that would be great.
Sure. Yeah, I mean, you got to love it. I think one of the barriers to this strategy is it's just really hard work, and it's a lot of calls at night to Asia or early in the morning to Europe, or obviously traveling to these places and meeting these companies and having good relationships with people on the ground that can help you understand, especially in small cap. Getting access is a challenge, but I think we're pretty good at that. Yeah, I mean, I think a good example. I mean, what I always say, I mean, people make investing too complicated. I think all you need to know about investing, here's the secret, is a dominant position in a growing market. I think if you think about any investment probably that you've owned that did well over any period of time, they probably had a very high market share. I mean, and that implies maybe patented products or barriers to entry, or there's reasons why that company has a high market share. And then you have to understand the market they're in, and is it a growing, attractive market? If you have those two things, I mean, you can think of Microsoft or Amazon, obviously dominant position, or maybe even NVIDIA, well, clearly today, dominant position, growth market. Now you have to answer to yourself, will it continue to dominate? Will that continue to be a growth market? I think if the answer is yes, then you could probably buy NVIDIA today, so as an example. But, we're generally small cap investors, and you probably would say, well, how do you find dominant companies in small cap? But there's a lot of niches that we find. I mean, you asked for an example. For one area, and again, it's a good example of what we can do at APIS, where you've probably heard of Ozempic and Wegovy. These are drugs. They're called GLP-1 drugs, and they're very popular, especially in the U.S. as weight loss drugs. I think they do 30 billion or something of sales, and people think they're going to do 100 billion by the end of the decade. That's interesting. We're not going to own Lilly and Novo. I don't know how to develop an edge in those types of businesses. But there's a company in Japan called Osaka Soda. Osaka Soda makes something called silica gel beads. This is a I would call it a specialty chemicals company. So on the surface, it doesn't look like a very interesting business, but they have a division, a healthcare division, which is about 15% of sales. And what's unique about that is most of those sales are this thing called silica gel beads, about 90% of the healthcare sales, and they make 50%, 50% operating margins. So all the other things that they do make sort of mid to high single digit type margins. They grow at sort of GDP. It's not a bad business. It's an okay company, but inside of this is a business. It's now a third of profits. And this is typical Japan. They've been selling to Novo and Lilly for 30, 40 years. They've helped them with all these are insulin products as well that Novo and Lilly have done historically, and they're a key supplier. So it's a consumable that's used in the production of these drugs. And so it's another way to play this trend. We see this high growth area, this interesting space, but here's a company in Japan with, again, dominant position, growth market, 60% market share. There's a company in Denmark which has the other 30% or so of this business. And it's growing at 30+%. And so here's a business that's a third of profits today. We think it'll be more than half of profits in a couple of years. We think there's really good, outlook for this. It's a very high switching costs, very high barriers to entry. They're built into what's called the drug master file. So, and Lilly and Novo at this stage, it's not a high, cost component. They just need to get more drug produced. That's their big challenge at the moment. So they're doing everything they can to get their supplier base to grow their business. So it's a typical APIS type of situation. We see something happening in one part, we think of who could benefit around the world. We happen to find a small Japanese company that probably very few people have heard of, that would benefit from that. And so that's kind of a typical APIS story. And again, it fits that high market share, with good growth outlook that we look for in a long position.
That's very insightful, and to your point, probably takes a lot of work to find these opportunities, not just in finding the company, but actually understanding where they sit in the overall marketplace for something like that. Taking zooming out a little bit across the whole portfolio, you have multiple, many of these companies on the long side, and as you mentioned, on the short side as well. Overall, when you combine all of these, you touched on the concept of net exposure before. Can you touch on what you mean by that, and therefore what it might mean through market cycles where the overall equity market is doing well and where the overall equity market is doing poorly?
Yeah, I mean, when I mentioned, I think our net exposure again over the 20 plus years we don't whip it around a lot. On the low end, it might be 40%. On the high end, it might be 60%. And we don't really run leverage either. I mean, again, in our small cap universe, in other words, leverage would mean owning more than, having margin on the long side. So typically we have cash on the long side. We might be 90% long and maybe 40% short. In that case, 90 minus 40 is 50. And so when we talk about net, we're talking about that number 50. So 90 long, 40 short, then that would be 50. And so again, if all stocks had a beta of 1, which they don't, but if they did, that would mean that when the market goes up 1%, you'd go up 0.5%. When the market goes down 1%,
perform exactly like the market does. When you mean
exactly. So obviously we're running stocks that will have maybe very high betas in some cases, maybe low betas, maybe different correlations, and of course there's a lot of risk tools to look at those behaviors. And of course, when you have market spasms where you have risk off periods, and you throw all that out, it can everything that worked maybe suddenly doesn't work for a period of time, and that's just comes with the territory. But in the long run, obviously if we can pick stocks that have maybe they have similar betas, but they have the longs and the shorts have a lot of alpha, then our shorts will outperform. In other words, they'll either go down more when the markets are down, or they'll go up less when the markets are in a strong phase. And our longs, we hope to outperform. They should go up more than the markets if we're doing our job, and perhaps fall less than the markets do in periods of weakness. And so if we can find shorts that outperform and longs that outperform, that's when you're really going to create, even though your beta in my example is 0.5 and your exposure is quote unquote half the market. If if we can pick stocks successfully, then we can generate returns above the market, even with a lot less exposure to the market, which is the goal.
So, moving on to market conditions, and it would be remiss of me not to touch on the current environment we're in. All that work that you do, all the analysis on markets and trends, how do you manage those things when we're in an environment that we are now, and a lot of the inputs that you have in your models analyzing companies may not be the same as they were? How do you adjust for that?
Yeah, it's definitely a challenging environment today, and I think this is we're talking in May 1st, I guess, or maybe May 2nd for you, um, of 2025, and every weekend there seems to be some pronouncement, and I think initially there was, oh my God, we're going to have a tariff in Mexico, and what's our exposure there, and how should we adjust earnings and things like that. And then the next day, well, we'll put that off for a month, or we'll change the tariff rate here. And so I think it's a little bit, the boy who cried wolf, and maybe we're getting too complacent in the sense that, but reworking all the numbers for a policy which is clearly in flux, um, you know, we've we've learned to, I suppose, and I would say even by nature, I tend to not want to overreact to any kind of these. I think these do represent opportunities. I mean, small cap stocks, the part of the universe we're looking in, can be very volatile. And for us, that's an opportunity. So every time we see a COVID crisis or significant macroeconomic change or political change that creates a lot of maybe forced selling or technical things that are going on in the market. If we can kind of keep our heads, those are the times where you don't like it when you're in it because you're probably losing money. But that's kind of sets you up for the next cycle. And if we there's always I think portfolio managers talk about upgrading the portfolio. You have two positions you like equally. One's down 20, another one's maybe not down at all. As much as it pains you, sell the one that's flat and use that capital to buy the one that's down 20. And so you get these opportunities, and I think even more so in small cap, to take advantage of that volatility. And sort of, if you can keep your eye on the sort of 3 to 5 year view, that can work to your advantage. And especially too, because our competition, because we're in that small cap space, is oftentimes retail investors in these markets who they get caught out on margin calls. I mean, you see it all. And you can kind of, you have experience, you can kind of recognize what's going on. Stocks in Taiwan that are limit down every night, and nothing has really changed. And so, if you can, kind of keep a cool head and take advantage of those situations, that's generally what we're looking to do in these environments. But I don't really want to change the structure of the portfolio. I think there certainly is more risk today. There's been a lot more government involvement in a lot of situations, politicians picking winners and losers. I don't like that. That's been a growing feature even preceding Trump, where we've had these enormous government spending programs, et cetera, that we have to factor in.
Well, in the last couple of minutes, Dan, it'd be great to hear how you think this will play out on a macro basis, in terms of putting on the spot a little bit, but in terms of are the tariffs going to be wound back? Is the market going to see through this? Tax cuts coming? What's the general APIS view around how this is all going to play out? Noting that probably by the time this podcast comes out, there'll be about 3 different changes between now and then.
Yeah, that is probably the case. I think ultimately, I believe that Donald Trump doesn't want to be known as the president who crashed the markets or destroyed the economy. I think he's ultimately a pragmatic person, um, and I and I think you've already seen elements of that. You've seen, the bond market will start to, and I think you've seen certain advisors who were at front and center who've sort of been pushed to the back, and other advisors who've been pushed forward. I think the more reasonable minds are getting pushed forward. I think Trump is listening to those people, and he may say he doesn't care about the stock market or what have you. I guess I believe that he does. And so I think ultimately he wants to see America succeed. And I actually don't think he wants to be hostile to foreign nations or anything. I think ultimately he wants to do deals. That's what he's known for. I believe you'll see, deals get done. I think the market has already sort of rebounded. April was just a wild month, down, I think even double digits at one stage and ending the month almost flat or, depending on what you're looking at. I think the market has already started to recognize that he doesn't want to destroy the world, and ultimately I think you'll see deals get done with the Japans and the Koreas and maybe the Australias, places like that, that will be ultimately pretty fair, and that the words that both sides will be very congenial. I think there is obviously some issues with China that will continue, and there's a rivalry there, and I think there's probably he does want to bring manufacturing jobs. There are probably structural imbalances. There are probably industries that we've let go that are strategic, chip making, shipbuilding, things like that, which he wants to see brought back onshore. And there's going to be a lot of opportunities, I think, for investors who can take advantage of some of these movements. And so I'm not pessimistic.
Uh, Great to hear. And Dan, that's been some terrific insight across the board, both on investment strategy and macroeconomics. So thanks so much for your time today.
All right. Thanks, Joey. Nice to be with you.